ETFs offer a convenient, low-maintenance way to gain exposure to gold, especially for long-term investors. These are traded like regular stocks on major exchanges and often come with zero brokerage or maintenance fees, depending on your broker. Here are some well-known gold-related ETFs. SPDR Gold Shares, GLD, tracks the price of physical gold. iShares Gold Trust, IAU, holds physical gold with a lower expense ratio than GLD. VanEck Gold Miners ETF, GDX, invests in gold mining companies rather than gold itself. Keep in mind, ETFs do charge annual expense ratios, so it's worth reviewing the specific fees before you invest. The benefit? Unlike buying stock in a single company, ETFs are diversified. If one miner fails, the ETF's performance is cushioned. Best for passive investors seeking diversified exposure. Watch out for expense ratios and tracking error. If you're comfortable selecting individual companies, gold miners can be a powerful leveraged play on rising gold prices. Unlike ETFs, stocks don't charge annual expense ratios, and reputable miners offer potential for capital appreciation and dividends. Here are a few established gold mining stocks to consider. Note, this is not financial advice, just general information. NEM Newmont Corporation, AEM Agnico Eagle Mines Limited, RGLD Royal Gold Inc., Gold Barrick Gold Corporation, KGC Kinross Gold Corporation, Sandstorm Gold Limited. These companies often have low PE ratios, strong analyst ratings, and, if gold prices continue rising, are well-positioned to generate robust free cash flows. Among them, Agnico Eagle Mines, AEM, consistently receives positive reviews for operational efficiency and asset quality. Best for investors looking for long-term gold exposure through equities. Watch out for company-specific risks like debt, management quality, and geopolitical exposure. Before we wrap up, a few things to clarify. This video is for educational purposes only. I'm not a financial advisor, and none of the instruments or companies mentioned here should be taken as investment recommendations. I do not own shares in any of the stocks or ETFs discussed and have not reviewed their annual reports, earnings, or debt levels. My commentary is based on market positioning and macro context, not deep financial analysis. Please always do your own due diligence before making any investment decisions. There's no perfect way to invest in gold. Each method has its pros and cons. What matters is aligning the instrument with your goals. CFDs and futures, fast, flexible, high risk. ETFs, simple, diversified, moderate fees. Stocks, long-term upside potential, no ongoing costs. In my view, if you believe gold is heading higher and you're not a day trader, ETFs or mining stocks offer some of the best ways to hold gold positions with fewer fees and more stability. If you're looking for an asset with enduring value, hedge-like characteristics, and fundamental tailwinds, gold deserves a place in your strategy. And buying on dips may be the most effective way to build exposure.